Hey there, welcome to our YouTube channel. I'm Ryan Chan, the CEO and founder of UpKeep. In this video, we'll be unraveling the concept of useful life in asset management. We'll delve into what it is, how it impacts financial planning, and its role in maintenance decision-making. We'll also break down how it's calculated and even walk you through an example to better illustrate this concept. If you're part of a maintenance or operations team, you'll find this information incredibly valuable. Stick around to the end to find out how the length of an asset's useful life affects its depreciation rate and ultimately your company's bottom line. Now let's dive right in. The useful life of an asset is essentially an estimate of the number of years it will remain in profitable service. Think about business assets like machinery, equipment, vehicles, and even buildings. They all depreciate over time. The goal of estimating an asset's useful life is to figure out how long that asset will stay in a usable condition. From a financial perspective, this means the period of time in which an asset will generate an economic benefit for the business. Now, it's crucial to understand that useful life is not the same as the actual life of an asset. A piece of equipment may last far longer than its estimated useful life, but it will likely need more and more maintenance as it reaches that point. Plus, an asset may become obsolete or require major repairs. An especially old asset, while technically functional, may be more of a liability than a benefit if it requires frequent repair work. In the world of asset management, useful life estimates are used to determine how long an asset should be kept before it's replaced. This is particularly crucial in maintenance planning as it can help inform decisions about whether to conduct major repairs on an older piece of equipment. For instance, if a mechanical asset is nearing its useful life and breaks down, a maintenance director may deem it to be more cost-effective to replace it than to repair it. When it comes to financial planning, an asset's useful life is used to calculate depreciation for tax purposes. As an asset depreciates, businesses can subtract the amount of depreciation from their taxable income for the useful life of the asset. So, how is useful life determined? Well, the useful life of an asset is rarely the same from one company to another. Factors like frequency of usage, working environment, and maintenance performed on the asset all affect its useful life, so it can be challenging to calculate an absolute value. Businesses may determine an asset's useful life through a variety of means, including standard industry practices, engineering estimates, past experience with similar assets, and statistics related to the asset. In addition, the IRS has compiled a list of useful life estimates for most tangible assets, and accountants may use those when calculating depreciation. These estimates categorize assets into different classes based on industry, and they may be useful when it comes to determining useful life. However, it's important to remember that the estimated values set forth by the IRS are not absolute, and the numbers can be adjusted based on various factors, such as technological advancements, economic changes, and actual usage of the asset. Let's consider an example of useful life. Suppose a paper manufacturer purchases a new boiler for use in their processes, namely steaming wood chips. Their previous unit lasted them 25 years, which is expected for large industrial boilers. As such, the asset management team might determine that the useful life of this boiler will be the same. However, the IRS lists paper and pulp manufacturing equipment with a class life of 13 years, and the general depreciation system period is only 7 years. Useful life is not the same as the actual life expectancy, and if the company insists on a 25-year useful life on their taxes, they could end up paying more taxes than they should. Their useful life estimate will impact their maintenance planning. As the boiler nears the end of its useful life, the company is less likely to pour money into fixing it, especially if they can no longer claim depreciation for the asset on their taxes. The longer the boiler's useful life, the longer it will make sense to keep repairing it. Now, how does useful life affect depreciation? Useful life is central to depreciation. In general, the longer the useful life of an asset, the slower it will depreciate. For instance, suppose an asset valued at $50,000 with a salvage value of $12,000 has a useful life of 10 years. Using the straight-line depreciation method, the asset's depreciation would be calculated as follows. $50,000 cost minus $12,000 salvage value divided by 10 years equals $3,800 per year. If the asset has a slightly longer useful life of 15 years, the calculations look like this. $50,000 minus $12,000 divided by 15 years equals about $2,533 per year. The asset provides a lower exemption amount, but the company would be able to claim that exemption for 5 more years. So to sum up, useful life represents how long an asset is likely to be profitable to the business. It is used to calculate an asset's depreciation while also helping inform maintenance and purchasing decisions. The longer the asset's useful life, the lower its depreciation rate will be, but also the longer the company will benefit from it. Thank you for watching this video. We've covered the concept of useful life in asset management, its impact on financial planning, and its role in maintenance decision-making. If you found this information valuable, please subscribe to our channel for more insights. For additional resources, visit our website at upkeep.com. Remember, understanding the useful life of your assets can significantly impact your company's bottom line. Stay informed, stay ahead.